Equity Market Update March 2022. FY22 marked another year of strong returns for Indian equities, with Nifty 50 and S&P BSE Sensex delivering year-on-year returns of over 18 and 19% respectively. The growth in equity market was driven by robust corporate earnings, strong global and domestic economic recovery, ample liquidity, low cost of capital, announcement of infrastructure spend by the US, accommodative fiscal and monetary policies, etc. This was partially offset by the successive waves of COVID-19, concerns over a slowdown in China, broad-based rise in commodity prices, accelerated pace of monetary policy normalization by the US Fed and other major central banks, crackdown by the Chinese government on education and technology companies, Ukraine-Russia war, etc. Mid-cap and small caps outperformed large caps. All the major sectors delivered positive returns, with power, metal, information technology, capital goods and oil and gas being the best performing sectors. On the other hand, performance of major global equity indices were mixed, with US and select European indices ending the year in positive, while Germany, Asian and MSCI EM indices delivered negative returns. FPI sold net equities worth $18.5 billion in FY22, as compared to being net buyer of $37 billion in the year before. Notably, most of the selling happened in the second half of the year, wherein FPI sold approximately $20 billion worth of equities. On the other hand, domestic equity-oriented mutual funds witnessed net inflows of approximately INR 2,35,600 crore in FY22, vis-a-vis net outflows of approximately INR 75,000 crore during the same period last year. Characteristics of equity markets in CY21. Broad-based equity rally in FY22. FY22 was the second consecutive year of double-digit returns in Nifty 50. Notably, the rally in Nifty 50 has been broad-based, and contribution from the top 5 stocks accounted for less than 50% of the returns in the past 2 years. Moreover, the broader market outperformed in FY22, as small-cap and mid-cap stocks registered higher gains than large caps. Rise in retail participation. FY22 witnessed significant rise in the participation of retail investors in equities and also increase in intraday settlement trading, although it has come off its peak in the last few months. The steady increase in the retail volumes is also corroborated by the sharp increase in new demat accounts over the past couple of years, as the penetration of discount brokerages increased. Historically, it has been seen that the heightened non-institutional activity has been followed by moderate market returns, narrowing of valuation divergences. The broad-based rally during the past year narrowed the valuation divergence significantly. Outlook. As on 31st March 2022, the Nifty 50 was trading approximately 18.6x FY24E price-to-earning ratio. While the price-to-earnings multiple is relatively high compared to the historical average, it could be considered reasonable in view of the low interest rate environment and the healthy corporate earnings outlook. Further, India's market cap to GDP based on CY23 eGDP is near 90%, that is, within the historical range of 60 to 100% over the past 10 years. However, the gap between 10Y GSEC and 1Y forward Nifty 50 earnings yield remains higher than its long-term average. Thus, in our view, most indicators are hinting that on overall basis markets are near fairly valued. Going forward, we expect returns from equities over the medium to long term to be in line with overall economic growth and largely driven by the growth in corporate earnings. Further, corporate earnings growth is likely to normalize from FY23 onwards after seeing a robust improvement in FY22. In view of the above, while markets hold promise over the medium to long term, it is prudent to moderate returns expectations in the near term. We remain optimistic on the economy and the equity markets over the medium to long term on the back of strong global economy, supportive monetary and fiscal policies, prospects of strong corporate profitability, healthy economic activities, etc. Resurgence of COVID-19 cases, slowdown in China, crude oil price settling at significantly higher levels for a sustained period, accelerated unwinding of fiscal and monetary stimulus by AEs, sharp increase in US yields, etc. are the key risks. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.